masses. I have to educate the masses. Gotta let them know about these money-making opportunities. All right, so let's get into options. Oh, shit. Okay, as soon as, oh wait, I gotta do it here, right? There we go. Let's let them know about options. One thing I will say though, which I don't have the advantage with the whiteboard, is my handwriting's terrible. So if y'all don't understand something I write here, just let me know. But hopefully you can understand that the word I wrote up here is options. So first off, let's talk about what is an option. Oh, that fat finger, that. What is an option? Right? So when we talk about an option, right, an option contract, that's essentially a contract. So you can think of it like a written document. Yada yada, yada yada, yada yada, yada yada, right? An option is a contract that states the following. It says that this contract is worth 100 shares of a stock. So, a contract is worth 100 shares of stock. It's a written agreement that says this contract not exactly is equivalent to 100 shares of stock, but it has a value of 100 shares of stock. And I know those words sound kind of weird, but just bear with me on this. This contract says I have the right to buy 100 shares of stock from another person, specifically the person who sold me the contract. So imagine there's two people involved in this party. So I'm going to erase all this real quick. I guess we just, I don't know why the eraser was gigantic before and now it's like miniature. So imagine there's two people. You got, you got Matt Billen here. I'm gonna draw him with angry eyes. Well, attempted to draw him with angry eyes. And then we got Cash Money. And Cash Money sells to Matt Billen this contract. He's like, here you go, buddy. Here's a contract of, let's say, Apple. Right? He gives me that contract. He sells it to me. Now, when Cash Money, so Cash Money, let's give the man some respect. Let's put dollar signs in his eyes. Boom. Cash Money, getting cash. He sells me this contract. He sells me it at an agreed upon price. And let's say that price is $1 per share. That fat fingering, that thing is annoying. $1 per share. So he gives me this contract. He's like, hey, I'm going to sell you this contract. And in this contract, it stipulates that, okay, I'll be selling you this at $1 per share. Now, automatically, every contract contains 100 shares. So in other words, the total amount that I'm buying this contract off of Cash Money for is $100. Now I'm like, great. I just bought this contract for $100. Now, let's talk about, what does that contract mean? What does it actually mean? Well, it means that I now have a right, Matt Billen here, he's got the right to buy 100 shares of Apple from Cash Money at a later agreed upon date. So he can buys it at a later date. And it says that he's going to buy it. He's going to buy this contract, or he's going to buy 100 shares. Eventually, he's gonna buy 100 shares. All right, cool. So he buys this from Cash Money. He buys 100 shares. So the question is, what's the point of doing this? Why would Matt Billen? Why would he say like, okay, why would he buy a contract to tell him that I'm gonna buy Apple from you at a later date for 100 shares, right? What's the rationale behind this? Why would Matt Billen want to do that? Well, there's a simple reason as to why he does this. When Matt Billen buys his contract, he buys it with a guarantee that Cash Money will sell Apple stocks to Matt Billen at an agreed upon price. So let's say this Apple contract, Apple's worth like let's say it's $360 right now. I think it's dropped below, but it's $360. Let's say this contract says Cash Money, he's like, okay, I'll give you this contract I'll sell you 100 shares of Apple for $340 each. Right, so he says, I'll sell it to you for $340 each. And then Apple is currently Apple is currently trading. If you guys look it up, Apple's like right now the value of the contract or the shares, 360. So what does that mean I'm doing here? Well, since Apple's currently worth $360 and I'm buying it for $340, oh shit, I'm buying Apple for a discounted price. So I buy Apple at $340. And so what did I do? I just made money off this contract. I'm like, okay, now instead of buying it for $360, I bought it for $340. So then that's a $20 difference, right? And then since I have 100 shares, that's 20 times 100. I sort of made $2,000 profit, right? Because this is Apple's times 100, and this is times 100, right? So that's 36,000, and this is 34,000. So I just made $2,000 profit. Sounds like, wow, what a fucking cheat code. Like, why wouldn't I always do this? Well, maybe it's not exactly $2,000 because I did buy it for $1 per share. So if I take, I had to spend a dollar, right? So I had to spend $100. So this is $1,900, right? This is sort of the basis of contracts. Let me see something because I did get an alert from one of the boys. You are the hype man in the chat. You always will be. Nah. Alright. So, you end up making $1,900 from this, right? Which is still, obviously, you walk away pretty nicely with $1,900. It sounds great. But that's not the full story. If things ended up like this, everyone would always be doing contracts. But what I did was a sort of gross understatement here. This right here, this is $1 per share. It's for for the sake of this example to kind of illustrate this, but that's usually not the case. This, instead of being $1 per share, it might have been something like $15 per share, which means it would cost me something like, or it might have been more like 15. It would have been like $23 per share. So in reality, this number would be 23. So in total, it would have cost me $2,300. Since it would have cost me $2,300, yeah, I bought it at a lower price, but I only make $2,000 off that price. So in total, right, if we were to look at a realistic scenario, and I'll go through realistic scenarios, it would have been 2,000 minus 2,300, right? And so I would have been at a net loss of $300. So now this is a more accurate picture of what just happened here. So let's describe the terminology that described everything here. So let me go here. Let me go a mess. Let's clear my canvas. All right. So in options trading, that value that we initially bought that contract for, that agreed upon price, right? That price of Apple, let's say that was at 340. right? That is what we call the strike price. This is a value in which, if you're buying a contract, and there's two types of buyings, but let's just, please continue just tuning in. Yeah, all right, no problem. This is the value of that contract at 340, right? Like this is when, there's two things called calls or puts. We're going to be talking the scenario of mainly something called calls. We're going to be looking at this scenario right here. So that means I am buying the right to own the right of 100 Apple shares, and I'm buying the right to buy it off of you for $340. Okay, so that amount that you guys make that contract for is what we call the strike price. Okay. Now, remember in that situation, I described that cash money, right? The man who's got money in his eyes, he's got actual dollar bills. Boom. Right? This guy right here, he's smiling. In fact, he's all green now. He's all money. Cash money, he sold that contract for me for a premium. He sold it for me for a certain price, right? Because he's not going to give me that contract. He's not going to be like, oh, yeah, I'll just sell you this for a cheaper price than it's currently at. No, there's got to be something in it for him. So he sells it at what we call a premium. In that case, in the example I gave before, that premium was $1. Right? And then it's $1 per share, which is, in total, multiply this 100. He sells the total premium of that contract is $100. Okay? So this value here is the premium. Okay, so currently we have the strike price, which is the price that you, the buyer and seller, agree that the contract is worth, that they'll be buying the contract for, that they'll sell you the stock for $340. And the premium is what the seller tells you. He's like, okay, well, I'll let you buy it off of me for $340, but you have to pay me this premium for me to do it. You're like, okay, and we do this. Now, what is the value in doing this? Well, actually, before I get to that point, at some point I mentioned at a later date, I mentioned this, that you'll buy the contract from this person at a late, that they'll have to fulfill the contract at a later date. So in other words, you buy those stocks of Apple for $340 at a later date. We call that date the expiration date. It's the date at which the contracts expire. Now this is extremely important to notice. So, and I'll get into that, but just keep that in mind. So we have something called the strike price, we have something called the premium, and we have the expiration date, when the contract expires. In other words, this is the date in which the contract has to be fulfilled. So that's the date that Cash Money has to sell me his Apple stocks for that value of $340. He's obligated, like by law, pretty much. He has to sell it to me because it's a binding contract. He has to sell it to me by that expiration date. Okay, hopefully this all makes sense, right? So premium, the strike price, where you agree you'll buy it, the premium, which is the value of it, and when the contract expires. In other words, the date that we agree that you have to give me those what do you call that? The contract. Okay, that sounds all nice and dandy, right? Now, when we're looking at a call, right, the value of a contract, right? So think of the contract, like imagine like there's a price tag to it. There's a price tag attached to those contracts. Now, what we have to figure out, or what we care about is, what determines the value of this contract, right? What determines the premium? The premium is the value of the contract. It's how much it's worth. There's three main things that determine that. Well, split it up this way. The first thing that determines the value of a contract is what we call the underlying. It's all one word. I'm just like kind of writing there. It's called the underlying. Now, what is the underlying refer to? That actually just straight up refers to the price of a stock. You can imagine that if a stock, right, let's say AMD, they're worth $50 right now, versus Apple, that's worth somewhere along the lines of $350, you could probably take a good guess that the contract for Apple is going to be worth more than AMD, right? It's the stock is pricier, therefore the contract by association should also be pricier. So a contract, the value of the contract it's determined by the underlying. It is also determined by the expiration date. And we'll get into that in just a sec. What we talked about here, when it has to be fulfilled. And something we call the implied, I'll write it out here, volatility. So these three things are what make up the value of a contract. Theoretically, this is all theoretical. Like how it happens in the market is going to be slightly different than what this might show, but for the most part, it's pretty accurate. This is if you're all interested, you don't need to go too much into this, but this is called the Black-Scholes equation. These are some people, some famous economists that they won the Nobel Prize for actually coming up with this equation. They were able to quantify the value of options. So give your respects to the boys in the math club here. But moving along, we have these three things. The underlying, so the price of the contract is determined by, the value of the stock itself that you're buying a contract for. The expiration date. When does the seller have to fulfill his end of the bargain? And the implied volatility of a contract. This one is a little bit, there's a lot to the implied volatility one, which I'll try to briefly talk about today, but for the most part, there's a lot to this. These two are fairly basic to understand, the underlying expiration date. So let's talk about this real quick. The underlying one is a fairly simple example, just kind of like what I detailed before here. AMD versus Apple, right? AMD is $50, Apple's $350, so therefore the contract price is going to increase. Let's talk about the expiration date. What does the expiration date do to the value of a contract? Let me go mouse in. Oh, and if you guys have questions, feel free to stop me. I want to make this kind of interactive, and I'll repeat your questions out loud to the chat or in the video, so that if someone's not watching the chat itself, they can see what the question was. So let me clear everything. And honestly, this type of video can go hours long. I'll try to do it in segments. Today is just basics as to what an option is, and then I'll get into sort of how to buy, sell options and all that stuff. But right now we're just explaining what exactly an option is. All right. So price tag again. You got the stock price, so underlying. Jesus Christ, my handwriting's trash. So underlying, the expiration date. So let's talk about the expiration date real quick. So back when we filled out a contract, there's a certain time period in which the seller, the person who sells us the contract, has to fill it out. They have to fulfill their end of the bargain, right? So let's take a look at what an expiration date is. So, for example, today we're in June 26th. So let's say an expiration date for July 17th. So, in other words, 07/17. And we're going to compare that to August 21st. Okay? So, now ask yourself this question. What contract do you think would be more valuable? The one that's being sold in July 17th or August 21st? And I want you to sort of think that to yourself. And, the answer that, the common person would think is to say that this one would be the most valuable. And when I say the most valuable, that means that it's the most expensive contract. However, that sort of thinking is wrong. Just hit him with the rainbow pen. Boom. That thinking. Oh, there was the red pen here. Where? That thinking is wrong. Actually, the most valuable contract is the August 21st contract. Now, why is that the case? What would be the reasoning behind, this contract being more valuable than this one? Well, think about it like this. If you have someone sells you a contract, right? So someone gives you that contract, whatever, paper, and it's you. Right? Let's think about this from the perspective of the person selling it. When they sell you this contract, they're saying, okay, I'm going to sell you this. Let's talk about, let's do AMD. AMD's $50. So let's think of AMD's current price. It's $50. Right? Now, when they sell you this, you buy it at a strike price of $45. Right? So in other words, this person is selling their right. They're telling you that, okay, I'll sell this to you at $45. Now let's think about the difference from July 17th to August 21st real quick. Now, think about it like this. What is the probability, right, that the value of this contract will go up to $60 in August 17th versus July 21st? Or actually, let's do even a later date. Let's do something like let's do January 1st, 2021. Let's do January. So let's say 01/01 of 2021. This is for 2020. Now, in this scenario here, think about the probability that at some point the value of the stock will be $60 versus this one where the value of the stock will be $60 from July 17th versus January 1st, 21st. In what scenario would this be more plausible to happen? In July 17th or January 1st, 2021? Thinking about it, you think about the price increase, price fluctuations and whatnot, there are more chances in a later time date, right? There's more chances that this will reach $60 than this one. So here, there's more chance for me to have, for the value of the stock to be more than $60 or worth more than the original share price. So what does that mean to the seller? Well, they're like, look, I don't want to lose out on money either. I'm selling this to you for a premium. They get a profit of the premium, but they like the value of that premium. They think to themselves, well, look, if I'm going to give you this contract for $45, and I have to wait till January 1st of next year, so 6 months from now, there's a good chance it's going to hit $60. This guy knows that. You know that. So what do they do instead? They say, okay, because I'm putting out myself for more risk for selling you the shares for $45, I'm just going to increase the value of the premium here. I'm going to say, well, this is going to be worth more money because I'm risking this guy he's risking a lot. He's saying he's not going to gain from that value of 45 to 60 because he has to sell it to you at that value of $45 because that was your agreed upon price. So if he's thinking, you know, well, in July 17th, it might reach, you know, $60, but more or less, it'll stay at $50. So how much does he lose out on? Well, he might only lose out on, you know, $500. Right? He might lose out on $500 in that, you know, from 45 to 50. But from 45 to 60, this man's losing out on $1,500. And just to explain how I got these numbers, you know, 50 minus 45 is 5. And then you multiply that by 100, so the difference in the shares is 500 versus 45 and 60, the difference in shares is 1,500. So, you know, 15 times 100. So this guy, he knows he's losing out a lot more in this scenario than he would be in the first scenario. That's why if you go for contracts, if you agree to sell a contract or to buy a contract from someone at a longer date, at a longer expiration date, then it's going to be more costly than that of a shorter date. And just to illustrate this, I'm going to go ahead and show you all Robinhood. Because I think Robinhood is pretty clean this way. Give me 1 second. If you guys, if the volume isn't good or anything like that, please let me know. Please let the boy know. I'm gonna move Robinhood to the other screen over here in just a sec. So we're using AMD as the example here. I'm gonna go ahead and switch scenes so y'all can see. Boom. All right. Flip back. So I want y'all to look at this. If I go to trade AMD options, or for those of you that might use Robinhood, this is what it looks like. And it doesn't look as clean as like the phone, but here, do you notice it says expiring July 2nd? So that's expiring next week. So let's look at those two examples. I said July 17th, right? And let's look at a $45 strike price. Notice the value that it's at. It's worth $590. So if you want to buy this contract from someone, then you got to buy it for $590. Now, let's do, next year, January 15, 2021. Oh shit, that $45 one is now pretty much doubled in price. Now it's worth $10.48, which is in other words $1,000.48. Alright. Yeah, so July 7th, $590, right? Yeah, $590, and then January 15th, it's now $1,048. That's a hell of a difference. That's a hell of a difference in the price. That's pretty much double the amount, right? So you can see they're selling at a higher price because it's riskier. Because more likely than not, AMD is going to be at $60 or at $65 or close to a higher amount than it is right now. Generally speaking, this is not really options, but generally speaking, when we kind of think about options, when we think about the stock market, for the most part, is bullish. In other words, it tends to increase over time. We don't really see it, stay stagnant. It's usually sloping upwards. So we all have a sort of expectation that it's going to continually increase, right? So we expect that the value of AMD will continually increase as well. Or at some point, at the very minimum, since there's more time, at some point it'll hit $60. We don't know when, but at some point it will, right? So that other person can't do anything with those 100 shares until their expiration is up. So they think of it like this: if they couldn't sell AMD at $60 even if they want to because they sold this contract to you, right? So the idea is that, you know, for them holding it for that long, well, you got to pay up a bigger price for that. Now, I want you all to see this because I mentioned before something along the lines of, oh, AMD, like Apple, the price of like like you'd actually be losing if you sold right now. Because you would think the cheat code would be, whoa, well, why don't I just buy at a price, you know, below the share price, right? So the share price is $49.81. Why don't I buy just at 47 bucks? I pay the premium, whatever, and then I can just go ahead and sell the stock. I buy the contract. I get those shares for that value, and then I sell the stock after the fact, and I make money that way. All right, so check this out. Let's do July 17th. All right, July 17th. The $49 stock, right? The share price at $49. The premium is $320. So let us do some math here. I'm gonna switch back to the whiteboard. Let us do some mathematics here, just to sort of explain this concept. All right. So the value, let's assume AMD is at $50 right now. So AMD, it's at $49.81, but AMD, again, $50. That's the share price. You bought it at the strike price of, so I'm just gonna write strike at $49. So in other words, and you have to pay a premium to buy that strike. So you have to pay, think of it like a fee for you to have this, right? The premium we saw was just it was $320. Okay, sorry, again, shit handwriting. So if we think about, you know, you buy it at that strike price of $49, right? And if you were to sell this right now, if you just sell it right at this exact moment, well, then you would see that you would buy 100 shares of the strike price. So then you would have to spend $4,900, right? $4,900, and then you sell at $5,000. So this is where you bought it at, and you sell at $5,000. So you see, you make $100, right? Cash. But you paid a premium for that. Can't forget this. You paid this for it. So since you had to pay this for you to have the $49 one, well, you gotta subtract that. You gotta, you know, subtract 320 out of this. And then what happens? Now you're in the red. So, in other words, you've lost money. You've now lost $220 as a result of this. So, what would be the point of doing this then? I'm kind of like doom and glooming this over here. I'm saying, you know, yeah, you can buy it at this price, and yeah, it's lower, but at the end of the day, the premium, right, kills you. Pretty much, you lose money off that, so you don't gain any profit. But what if by the time your contract expires, so let's look at July 17th. What if AMD, instead of staying at $50, let's say it goes up to $54? Okay, so it goes up $54, and then you still have a strike price of $4,900. So let's take a look at what happens in this scenario here. So you have it's $5,400 is the current value when it goes up to $54. Shit, let me erase that. I mean, it's pretty solid. I like this. Boom. Boom. Okay. And you sold it at $4,900. So that's a $500 profit. You're in the money again. Right? And then since you bought it for, you know, $320, all right, you made a cool $180 on this trade. Nice. Very nice. Very nice stuff, right? So you made $180. But wait a second. Wait just a darn minute. Why would I be suggesting options in this case? You know, what's the point of me telling you all to do options? Why don't I just buy, you know, AMD? Why don't I just buy it at, you know, well, let's say if I bought it at $50, like what it was worth now, and then I sell it at the $54 mark, yeah, I make money, right? I don't make, you know, the 500 that we would have like initially gotten from the sale here, but you know, in total I only make $180 in this scenario. But if I bought it at $50 and I sold it at $54, well, I would have made $400. And you are right, you would have made $400, right? So if you bought at $5,000 and you sell at $5,400, right? Yeah, you make that amount. That is true. Let me ask you this though. You had to buy it for $5,000. You had to spend $5,000 on this stock to only gain $400. While in this scenario here, how much did you actually have to spend? You only had to spend $320. So, you know, if I spend $320 to make $180 versus having to spend $5,000 to make $400, well, shit, that's a lot. This is, what, a little bit over half the investment? So I would have gotten like a 60% increase on this. While over here, I'm only getting what would seem to be, I guess, like, you know, something like 2% of my investment back. So you can kind of see, or 5% I should say. Yeah, close to 5%. No, close to like 10%, sorry. Yeah, 8%, that's the exact number. So this is 8%. So I only gain 8% here. While in this scenario here, well, from 320 to 180, something like 60%. So, damn, I made some good ass money, didn't I? And this is the inherent advantage of options, right? Now, normally speaking, as option traders, we don't actually ever sell. We don't ever actually wait till expiration. It's pretty dumb. Not dumb, but there's very rare scenarios where you would actually want to do that. Because if this thing hit $54, remember how I said, you know, in the little price tag here? The first part I said was the underlying. Right? The underlying just went up. So you know what else goes up along with the underlying? The premium goes up with the underlying. So now think about it like this. You own this contract, right? So let's say in that cash money Matt Billen scenario, Matt Billen, he owns this $320 contract, right? This contract was originally worth $320. But because the underlying value went up to $54, so it went up another $4, the value of this contract might have increased more or less, a guesstimate, to $520. And what did you just do? So since your contract is more valuable now, what can you do instead? You can just go ahead and sell it off. You give it to another guy. We'll give it to the Bear Trumpet guy. Try my best to draw. This is my imitation of a bear. This is Bear Trumpet guy. And you give it to him for $520, and Bear Trumpet guy buys it from you. And what are you left with at the end of the day? You're up $200. And that's just because the value of the stock went up. So the underlying increases. Okay? So, I hope this sort of, little scenario here, this kind of example I drew up, kind of explains a little bit about options. I do want to get more into, sort of options in terms of like explaining like what happens. There's a lot of topics we haven't talked about, but at least this is sort of like an introductory video. Maybe I'll want to do this like I'll try to throw up another video tomorrow about talking about the implied volatility. That's the other sort of tag here. So, and we still haven't really talked about expiration date. We've talked about like what determines. All we've been talking about has been what determines the value of this contract, and we've talked about slightly about how the contract can either increase or decrease in value through the underlying. The expiration date, though, we haven't really talked about like what effect does it do on this contract, and we haven't talked about implied volatility at all, which we will get to soon. But I think for today, because I'm hungry myself and I want to eat, I think for today this is a good start into options, into understanding sort of like what's going on here. Nah, man. There's no limit. The limit of how many. Okay, so one of the boys in the chat asks, this is his question in reference to your explanation of the premium. It's better to use options because of the ability to invest a small amount of capital. Is there a limit to how many options you can trade in a day? No, there is no actual limit to how many options you can trade in a day. You can trade as much as money as your account have. There is something called the overnight buying rule, which I have to do a little bit of like reading about. It's something like if you have to have like half the amount of like your option contracts, like it's a weird rule. I'm gonna have to do a little bit of research on that rule. There is that one limitation, but generally speaking, like you can spend as much money as you have in your account for options. That's the general thing. That's the general thing, and I think this will be a good time to like finish this video for today. I'll continue on tomorrow. But if you all have questions, then I can take them in now.